and welcome to week number 33. Starting off by having a look at the Scotiabank CFTC report, there was a bit of movement on the euro where long positions did add, but shorts added a bit more aggressively, resulting in open interest over 700,000 contracts, which is quite good. That's what you like to see. That brings in volatility into the market, but it also means that basically euro shorts or euro longs are now sitting under 5 billion contracts. It's interesting to see how this dynamic plays out long term. By the looks of it, United States will be raising rates quicker than in Europe, which basically means some of these longs should possibly come off at some point, and that net position go closer to zero, and that should weigh on Euro USD on the long term. GB as well, a bit of movement there. So open interest unfortunately dropped a little bit. Short positions took some off. Long positions added a little bit, and it ended up being a bit net positive on GBP. The thinking right now is with the Bank of England is thinking a little bit more hawkish, and that could possibly feed into the crosses, probably less than GB USD. Not a lot to report on the commodity currencies. Nothing really bigly moved. A bit more short adding on the Aussie because of what's happening in China. But it's finding it really hard to see the movements in the FX pairs. You can see there was huge positioning short, but Aussie hardly moved right now, and that might be the case going forward. But before I crack on with the calendar, there's a phenomenon I would like to explain that's happening right now in the short end of the yields in the United States and Germany, and the next trade idea for Euro USD going into the next week, as I strongly believe that you'll find it very, very interesting how this played out in the past. I'm going to do a quick explanation. So this video is going to be a little bit longer. I'm going to be a quick explanation how the short-term yields work in those two countries, how they affect Euro USD, and then we're going to move on to the calendar to figure out how we can find a possible tradable scenario out of all of that. So we're looking at the US 2-year yields. You may or may not know that US issues different types of bonds, notes, and bills, and they stretch anywhere from month all the way to several years. So the 2-year yield is highly sensitive to the interest rate that the Federal Reserve sets. Interest rate in the Federal Reserve right now is not about to move this year. It might move next year, but for the time being, we are tight in this. We are tight down to this tight range between about 100 basis points to so 0.1 to 0.25%, or if you go by basis point, 10 to 25 basis points. That happened since the crash came in late March, where they cut interest rates aggressively. 2-year yields reacted to reflect the current pricing of where the Fed likes to be. So I've drew out very early in the recession last year these two levels, because I was very certain that we cannot move out of these zones. And that was fairly correct. So the 2-year yields, every time they see the upper band out of some euphoria that the Fed will be raising rates at some point, they keep dropping back because the Fed is controlling this range very tightly. On the other side as well, every time it starts dropping to the lower band, it somehow magically finds its way back up, and it cannot escape out of these levels for the remainder of the year possibly. That's one thing to consider. Let's have a look at what the German 2-year yield one does. Because the ECB is in a similar scenario where they are not about to raise rates, definitely not about to raise rates, but they're also not thinking about cutting rates. So they're fairly comfortable where they are with the rates. They don't feel like cutting rates will add anything more. They might add or take away some of the quantitative easing. Right now stable, but in terms of what's happening with rates, we have the same scenario here. So last year, when the recession kicked off, we saw this huge spike in 2-year yields on the German side, and then it just started playing around in this range. So we don't seem to be able to take out this minus 80 basis point level, and we're definitely not able to break out any of these highs because the ECB won't be moving on that side of the yield either, right? So I'm going to go back to the US 2-year. And I'm going to overlay the German one, so we both understand now the dynamics of what those two yields are doing and why they cannot move out of the ranges. Now the question is, where's here the trade idea? Where's the discrepancies moving along? There's the obvious thing that cannot escape. So if you go back to what we had here in February, we saw the German yield spiked quite high at the top of their range. And look what the US yields did just 1 or 2 days before that. They were at the very bottom of the range. That means that if you are actively trading in this environment, you know, okay, US 2-year yields can't move any lower. At the same time, you knew German yields can't move hugely any higher. Any spikes are just really making it cheaper for you to sell it. So what happened then? The German yields came down and the US yields went back up. Now, let's see when I was in the calendar. That was about, 24th, 25th February. Maybe the build-up was a couple of days before it. Now let's have a look what that looks like on Euro USD. So we're looking at about 24th, 25th of February, which was around this candle here. Do you see that green candle there? So that red candle, green candle. So you were in that environment. You were looking at this. If it was looking like that, and you're looking at the yields, and you think, all right, the German ones are coming down, USs are coming up. There really is negative Euro USD. What is that doing here? And then you get this massive, unquestionable daily pin bar telling you to sell, and sure as hell it does drop, and it tanks massively for a good month or so. Now you might think, okay, all right, fair enough, that looks cool. Maybe that was just a one-off. Maybe that doesn't happen all the time. Well, let's have another look when it happened again. So here about in late May, beginning of June, we had US 2-year yields not very at the bottom of the range, but quite low. But we had the German yields sitting quite high again. At a divergence, do you see that? Huge gap divergence for no reason. You know Germans can't go higher, you know US can't hugely drop any further. And let's see what happened with Euro USD. So again, back of May this year, and we came in a position where Euro USD started rallying quite strongly into the back end of May. Here's the end of May, so 24th, 26th. You get a couple of candles here playing about. Looking at your yields, you know Euro USD can't really go anything high, and you want to sell aggressively, or you even want to sell in now because of what you know about the yield, short-term yield spreads happening there. And then you get this daily candle. Again, very, very difficult to question the structure of this. It's bearish, you know you want to sell looking at the yields, and sure as hell, Euro USD does drop again. Now we examined two scenarios where it's both bearish for Euro USD and the yields play the other way. But the question might pop in your head, what if it moves the other way around? Is there any way of, could it play out positively as well? Yes, it can. Here we had the opposite. Do you see that here? What happened to 2-year German yields over here in the beginning of November last year? So 2-year German yields dropped down. On the other side, let me zoom in a little bit, make this a bit easier. On the other side, US yields start moving a bit higher. And while you may think, okay, US yields were at the bottom, they still could have moved higher. You know that German yields are definitely can't move any lower than this because it was sitting in that range. There was no reason for it to look for lower rates. And let's see what happened to Euro USD. So what was the date? The bottom happened around end of October, beginning of November. And let's see what happened to Euro USD in that month. So this is the 2nd of November, 3rd of November, massive bullish candle. And see what happened here to Euro USD. Huge surge. I've got another one for you. I'm going to wrap this up because I feel like I've got the message across quite neatly. So where you have the ranges playing out against each other, you want to express your view on the FX market. And this trade goes back to last year. So last year we had US yields dipping, right? We had dipping in very close to the bottom of the range in early August. And you had your German yields sitting comfortably at the top of the range. Now mind you, now in hindsight, you can see it moved higher, it played about until it finally tanked. I was actively live trading this. I was actively looking for Euro USD shorts and traded once or twice. And let me show you how it all played out. So last year, August, beginning of August was around here. So that's end of July, at beginning of August. And then you had like the 3rd and 6th. So I saw this rally happening and I was quite confident this is becoming very cheap for me to sell in this. So I sold. And then this happened. And then I was very confident I'm going to get another sell because of what was happening to yields. I just thought it's going to create sort of like a fake out. So I started getting short again and was a little bit in the money, and I had to scale out very quickly. At this point, I personally gave up a little bit on the hope that this is going to play out soon because I'm sitting now a whole month trying to short this thing actively knowing that the value trade for EURUSD should be lower based on my yields, but the trade actually did not come together until the beginning of September. We had that stronger rejection on EURUSD, and the beginning of September would have been these candles around here, and you can already see, so US yields bottom of the range, German yields too overpriced, and then kind of all played out, and EURUSD did find a good several hundred pips lower. Long story short, fast forward to today, we have EURUSD trading just above 117, close to 118 levels. Looking at its short-term yields, we have German yields close to the bottom. Actually, it looks like it did carve out a little bit of a bottom. We have US yields at the very top of the range, unlikely to break these higher highs. In my opinion, EURUSD should resolve lower in the short term because German yields can't go any lower. Look, so that's the German yields. German yields can't go any lower. They should be resolving back towards its mean. US yields quite rich over at that range, should come down lower, and that should reflect in EURUSD. I would like that pair to start climbing towards 119. I think that would be very fair. Now, what could be the catalyst for all of that? Next week we have the Fed FOMC minutes. Let me find it. There we are. After FOMC minutes, so London time will be about 7 o'clock. In my opinion, based on what happened to the inflation reads last week, it's putting the Fed into a bit of a back foot, and I think markets start thinking, okay, tapering will happen, but not that quick. Rate hikes won't happen, not that quick. There's a bit of repricing going on last week into this week, and I think there should be a drag on the dollar, and there should be positive for the EURUSD. Now, based on what we know about yields, that should nicely play hand in hand. So that's one of the trades I would like to explore. Actually, in my opinion, I think USD CHF will be a better way of expressing that. I think yields are a bit compressed right now. They might not go up too high, and I showed you the correlation between yields and USD CHF very closely, and I think that should mean that USD CHF should start moving towards the 0.9 handle, maybe a bit 10 pips higher. I would probably take profit closer to here, but that move here should find several relaxed lows. I'm going to put an arrow on it because sometimes it's easier to explain it with arrows. I'm looking for this to come down to about here in the coming week. But there's some other things we have going on next week. It's not only about USD. We also have one of the most important events, in my opinion, is the RBNZ meeting. And here's a very interesting thing about the RBNZ. Everybody has priced in that they will hike, right? The problem is market has started pricing that will do 2 hikes all in one go. So usually central banks tend to hike or cut rates in 25 basis point steps. Now, market is now 25% pricing in that the RBNZ will hike in 50 basis points, which is, in my opinion, very unlikely. I think that the thinking is because they cut last year so aggressively, 50 basis points all in one go, they might add it all in one go as well. Now here's my thinking. If for whatever reason they do the 50 basis points hike all in one go, that will not be positive for the NZD. So maybe short term you'll find that NZD will spike, and I'm going to show you one of the pairs which I think could probably move a bit stronger, maybe in NZD USD, to some extent Euro NZD as well. If you look at NZD USD, if you get 50 basis points hike all in one go, which I don't think will happen, you're going to see one strong move up, and that's about it. You're not going to see anything more out of NZD. If we do see one hike, logic dictates, because market was pricing in for 50 basis points, you should see a bit of a pullback, but then the remainder for the following rest of the week should be quite positive for the NZD. Why? Because the RBNZ will be on a hiking cycle. That means they will be hiking twice this year, probably 1 or more 2 times next year. That keeps the positivity up in the NZD pair, and I think the flows should be NZD positive. In my opinion, because I saw these dynamics play out in the past when market was aggressively pricing something, and it was very the obvious thing. Sometimes you might see a bit of a step back in the pricing of the FX, but then it does resume higher because RBNZ is hawkish and they started a hiking cycle. It's not like a one-off. If I do the 50 basis points, it's very much like there's going to be one-off. They're going to be waiting for more data. But if they do incremental, then the hope is still up there for it to move higher and higher. I don't tie myself down to certain levels. I just want to make sure that what's happening on Wednesday morning my time or at night if you're in the US will be coherent with the patterns I've seen in the past, where there should be continued support for NZD on this pair. And I really like Euro NZD as well. In the last few videos, I always noted that this yearly open on Euro NZD should be quite stable. So far, it's playing out nicely. I still think there's still more pricing left for Euro NZD to drop lower towards maybe another 200-300 pips lower over the time horizon. So it's two trades I'm looking at and I'm a bit more comfortable about. There's a couple of more interesting data points for the Canadian economy, as in the CPI. I'll be watching market reaction to that, and also unemployment rates, obviously, in Australia. I'll be looking at those as well, but I'm not sure which way I will be trading those yet. I think things will make more sense once we start trading early Thursday, or once Friday comes online, have a better understanding of where I want to position for the rest of the week in terms of risk sentiment as well. It was a bit longer video because I really wanted to explain this short-term yield movements in the US and in Germany, how it reflects on Euro USD. I think you will find this useful in the coming month and years to come as well, because these 2-year yields are highly, and I cannot stress enough how much the central banks aggressively control that side of a curve. They're like sitting on those and they won't let it move, get out of hand. And then that makes FX trading sometimes easier once we hit those extremes as well. So I hope you will find this useful in the months and years to come as you progress in your trading career. I wish you very successful next week, and stay consistent with just trying to find the volatility pockets using the FX calendar. That means you're going to cut down on sitting time in the market and just waiting for things to explode when you have at that time and date here telling you when things are actually moving. I wish you a successful week. That's all from me, and thank you.